let's hop into it, Tony. So I
Yeah.
wanted to, so starting out, a couple years ago, I found Tony. I was always impressed with your top-down approach to markets, your commitment to the commodity and the commodity sectors, and my room has, like I said earlier, my room has they know me as kind of I criticize newsletters quite a bit, but Tony really puts on he's a trader first of all, and Tony's probably the main person that I read constantly every day. Subscribe to his letter, always really good stuff, and above all, you're a risk manager. And that's what I love about it. You have newsletter services where people don't really put that together, that, this isn't just a, hey, I'm going to throw out this call. This is a, hey, I'm going to throw out this call, but this is when I'm wrong. And
Yeah, we're gonna manage it. Yeah.
yeah, and that's the big difference with Tony. And so I just want to ask you, can you tell us a little bit about your background? I know you started in the 90s, FX and commodities markets. So what did you learn around that time? How did you get started?
Yeah, sure, Jason. So I started in 90 right out of college. I started in an FX desk at Sumitomo Bank, and that was really, really valuable. I started off on a forward FX desk at a major Japanese bank. And so I started right out of the gates learning the machinations of a treasury department, right? And seeing money flows and who and why are the customers and what's going on there. I went from 2 years there to 2 years at UBS to 6 years at Goldman Sachs. And I kind of call that the first half of my career. I kind of divide my career in half, where the first half I was a commodity trader. The second half I was a equity sales trader. And then I finally became an entrepreneur in 2016 and went out on my own. So to go back to the first half, as a commodity trader, I'll discuss my, mainly my experience at Goldman Sachs, which is where I learned 90% of what I know about, risk management and being rigorous as a risk manager. I can start by saying that as a trader at J. Aron, managing risk for the precious metals and commodities desk, it was to start, it wasn't even like you worked 5 days a week. It was like your week started on Sunday afternoon when you had a call with your manager to discuss what the plan was for the week, into trading on the Tokyo Commodities Exchange Sunday night, into Monday, into the whole week. And then I used to call it a 5-day day, where it was just one big long trading session, ended when the New York close came. And that's when you finally got to take a breather and not think about markets for 5 seconds. Because from Sunday night until that point, you were doing nothing but providing liquidity for clients of the bank, traders, proprietary traders on the desk, basically every kind of client under the sun, and then managing the risk in your book the way and shaping it the way you wanted it to be. So that's kind of how you spent all of your time, which entailed having a view. Right. That's the one thing that you learn at Goldman Sachs is kind of like, if you're in the trading seat, the seat has value. And if you have a view, you're expected to capitalize on it. Right. Like that's your job, is to play offense in that seat. So when you're kind of tasked with the job of managing a book and playing offense all day, you kind of figure out, what your weak side is, right? And say, okay, what's my risk to this book, and figure out how to protect that so that you can play offense and sort of try to enact your plan, no matter what that might be. And at J. Aron, a lot of our strategies were not only directional strategies in commodities, but also ARB strategies, where we would say be long a ton of physical and short futures, or vice versa. And those were really our bread and butter trades. Those were really how we took massive, massive swings at P&L. And those were the hair-raising episodes that had to be managed. When you had a position of, say, 30,000 futures contracts in gold against London bullion, long futures and short London bullion. So that's a huge position that needs to be managed, because obviously the relationship between physical and futures is going to always be slightly changing, right?
Yeah.
So that's the type of trading that I sort of grew up in as a trader. And what's good about it is that it's very 5-dimensional. Commodity trading at a desk like J. Aron, there's so much to your book that you have to manage that, once you sort of pull out of that and start managing your own nest egg, it gets very simple, right? You don't have to quote anybody on your own nest egg, right? You don't, that you never have positions taken from you. right? You're not interacting with anybody. You're always playing offense with your own account. So, at J. Aaron, you learn sort of things about the money markets. You learn about the commodities that you're trading. You learn about how foreign exchange affects your positions and things like that. And so it's really a very multifaceted job and a multifaceted risk management seat. And so it really translated really well from there when I left there to go chase the dot-com bubble, quite honestly. I left Goldman Sachs in 01 after they went public in 99, 2000, or excuse me, I left in 2000 after they went public in 99 because I had a safety net and a chance to try something on my own after being there for 6 years.
Yeah.
So from there, transitioned out of commodity trading and learned a really valuable life lesson because I went to sit down and trade tech stocks with the NASDAQ at 5,000 and oil was 10 bid at 12 and nobody cared. And gold was 250 bid at 350 and less people cared. So, it was really, really wild to jump over to the technology world and sort of get the joke finally that this was a market that was about to implode and see all of a sudden a commodity super cycle start, over in the other window where, all of a sudden oil goes from 25 to 30 to 40 to 60 and gold goes to, from 400 to 600 to 800. So what I managed to do was apply my knowledge in those commodity markets that were taking off to the equity world. And I sort of went through my Rolodex and noticed that I had a lot of friends and a lot of seats that traded equities, whether they were at a hedge fund, a mutual fund, or family office or something like that. So I became an equity broker and really a natural resource-based equity broker because I had this wealth of commodity trading knowledge that I had just left behind at my seat at Goldman Sachs when that market went berserk. So I applied all of that I knew in commodities to the equity markets and was able to get really good leverage explaining to people like, you guys don't understand this move in copper. This is not a one-day event, right? Like this is sustainable, right? We've got a backwardated market here. We've got exchange shortages. We've got foreign buying, China buying, left, right, and center. So what we're seeing today is sort of very much, muscle memory from what I witnessed in 2000 and 2001 and all the way through the next decade, which kind of put me in a good position for what's gone on in the market since we experienced COVID and then the lockdown. So I don't want to go on babbling forever, but that kind of defines my career as it went from commodity trading to equity trading. And then in 2016, I just finally decided to stop sharing revenue with people and go out on my own.
Yeah, that was great. It wasn't battling because the next question actually was, so 2000 you had this switch, with commodities and so on. So I wanted to get into that and understand like what you saw there and what it taught you later, because you being a guy now who's like really pounding the table on this stuff, and everybody in the world's like, well, it's, might as well be transitory. We're hitting resistance and every single thing, but as well as I do, that commodities can go a lot further than anybody's ever dreamed of. And you're seeing, and if you're a technician, which you are, you're looking at the charts, you're seeing these breakouts, you're seeing copper breaking out. Like it's exciting. You're watching these things kind of develop. Once again, we're always risk managers first, so if this comes against us, that's another story. But at the moment, this really looks like it's building a lot further. So very cool. Glad you dug into that. So let's talk about your book a little bit. I remember you came out of the crash, and I've been sub to Tony for a while, so I've seen his stuff. Came out of the crash, long some blue chip tech, some of that, and then silver, gold, and so on. And then you started switching. And you've been the one really pounding the table since about May, I want to say May or June, like, hey, the commodities are starting, this is getting ready, this is going to start moving, let's start positioning, right? And you started positioning into copper miners, at metals and mining sector is one of your ones you've been in, home builders and so on. And, really seeing that at that point, I want to go back, and you saw that happen. You were on the wrong side of it back in 2000, 2001. And now this time you're really on the right side of it. So what did you see this time that was similar to last time when you were on the wrong end of it, that this time you could be completely on the right side of it?
Commodities left for dead, right? That was the one thing that was the same in, call it 2019, maybe something like that, 2020. and the same as in 2000, although at very different prices. You still had commodities left for dead, Jason, in a number of different ways, right? You can look at the BCom, the Bloomberg Commodities Index, and just observe the trend, right? A pretty clear 10-year secular downtrend into a kind of a trough where they just consolidated at what I call the nobody cares levels, right? They're trading sideways. They're not going to break down significantly. The upside is not that exciting, and really nobody cares. What you have is all the physical merchants trading commodities and all the speculators just sitting outside the ring going, I'm not getting into that. Right. So what changes is the big thing for me, and the biggest financial headline that I've ever seen in my life is the Fed taking their balance sheet from 4.2 trillion to 7.4 trillion in one fell swoop in response to the lockdown, right? Like that didn't get a whole lot of news coverage, but to me, that was like a heart attack event. That was like, what in the world what have they done? Like, they have crossed the Rubicon, right? So, we had been worried about inflation as our debt pile grew and as the Fed balance sheet grew to 4 trillion. And then when you see them do something like that, you see the biggest economy in the G20 literally mortgage our kids' future and borrow, 3 packages of $2 trillion, right, from the Treasury. That something dramatically has changed, right? And so going into that, what you build into from there is, wow, the biggest economy in the G20 is levered to the gills. That is bearish the dollar, right? And so when you get into that theme, you're like, okay, so this is going to be bullish hard assets because we have a potential inflationary scenario here. And then once you start talking to people, and people are still in the old mantra from the last 5 years of inflation, no such thing. Inflation, no such thing. Inflation, no such thing. And they just sound like a bunch of babbling idiots. And you're like, no such thing. How about when the Fed balance sheet goes from 4 trillion to 7 trillion? Does that wake you up at all? And people were still like, nah, technology is deflationary, debt is deflationary. There's nothing really to worry about here. And so for me, this was just a repeat of what I had seen 20 years ago. And it was like, okay, how I trade by now, let's start moving money towards these hard assets, right? While they're still cheap, while we're going to add to each one as they break out, right? So with that technical overlay of understanding trend changes and what's going on and seeing the grains complex change on a dime and first metals went berserk, we got a chance to dig into some of those commodity trades that we've seen before. Markets went backwardated, tightness, supply disruptions, and it's just the same old narrative playing itself over and over through the markets. And so you can move money into these spaces and you can buy Freeport in 17 and say, this is the wrong fucking price, right? Because copper is about to go on a $2,000 run because of what just went on the Fed's balance sheet and the grab for hard assets that's going to happen. So we had that trade unfold right in front of us. And then we also we were fortunate enough to live to see crude oil go negative, right? And to a commodity trader, at that point, you're looking for shoe boxes to put oil in around the house. You're like, can I put oil? What is this? Does this hold oil? Can I put oil in here? Right. And that's when I called up my friends that still work at the Goldman Sachs Commodities Index, the Goldman Sachs Commodities Desk, and say, I dare anybody to price me up my lifetime supply of gasoline right now. Because gasoline was down to like 30 cents or 50 cents a gallon at the lows. And I was like, price me up my lifetime supply. I want to buy it right now. Yeah. And, when they start thinking like, we can't do anything like that. That's crazy. But when you're looking at the board and saying, gas at this price, $5 crude oil, let's just store it all and buy it, whatever happens. So we had that trade unfold in front of our face. That was an obvious buy. So I was bullish from $15 down to 0, back up to 10, back up to 25. I mean, I'm still bullish at $60, $64 bid, and I'm still bullish. So we're living through this redevelopment in the energy sector. So there's a lot to unpack there, but I mean, we can draw 5 different storylines and narratives around why commodities should continue to go higher for the time being.
Yeah.
And so, when you start to recognize those, recognize the stories, recognize the patterns of backwardation, et cetera, and what happens to follow, and then you look at the charts on a 20-year basis and realize how cheap this stuff is, that's not a tough allocation to make in the old investment portfolio right there.
So perfect. That leads us into our next one. And one addition, Tony, when I that was an awesome trade. So I didn't have the balls to really go into oil. I did a gasoline trade around that same time. You did crude's negative. You're like, I'm gonna go out a few months,
Yeah,
buy this. I mean, it was a recommendation. It was phenomenal, and that's one of those things that a lot of people really can't do. The world's falling apart at that point. Everybody's sitting there. This is the end of oil. I mean, that's what everybody kept saying. Solar
yeah,
stocks have finally won. I mean, it was the end. And
yeah,
anybody who understands the futures curve understood that wasn't exactly the case.
right.
And so Tony came in and started buying. I think it was December. It was April at that time, and you bought the December futures and basically held that December futures all the way to 40, and then rebought again. And I mean, it's a good trade. You're still in that trade in a way. So that's very cool. The next one I was getting into was the energy market. So also after that, we talked about Tony going from the metals and mining, home builders, which you still have, but then you start going into the energy markets. You're buying Exxon and all these things, and basically like, and I was getting pretty bullish on those at the time. And you're just sitting over there pounding the table publicly. This is the time to buy energy stocks. This is it. Everybody's leaving them for dead. Once again, it was the perfect opportunity, and the market kind of was giving hints that we're shifting that direction. I mean, financials started moving, outperforming, energy started outperforming in November, and so on. So I mean, it was so great because it was the perfect storm. You have the election, and I think you pointed this out as well, where you have everybody like, if Trump gets elected, energy's going to do well. If Trump doesn't get elected, energy's going to do bad. And you're over there with the opposite view. And that was, for me, that was also a learning curve for me, kind of being like, okay, this is, trading an election is something that I've only done a couple times now. So that third time, basically, like you coming in saying those things was like, oh, okay. And then you watch it happen, you're like, oh, that was perfect, So what are you seeing now in energy? A lot of people, every time, because of everybody getting beat up so bad over the last few years in energy, everybody's like, well, I don't really want to. I mean, the last 10 years, we're being honest. And then everybody's like, well, I really don't want to get into that trade. Well, every time it sells off, they're like, it's done, it's over. What are your views, and how do you kind of stay with your conviction in that trade?
So to stay with that conviction, a great question, Jason. To stay with the conviction in that trade is always a 30,000 foot up view, right? And when you go from, Exxon being the biggest stock in the S&P 500 in my lifetime, and I think that was in the 90s, correct me if I'm wrong, it might have been
Right.
a little earlier, but give or take. Um, I'm not that
Into
great
the
of a
2000s a
historian.
little bit too. Yeah. Yeah.
Yeah. So right, okay. So we've seen the reign of Exxon, right?
Mm.
Now all of a sudden we turn around and we see technology. The innovator is what's being valued in the markets right now, right? The technologist is the god in the markets, and commodities, as we observed, were left for dead. Down to the point where energy is, all of 3% of the entire S&P, right? So now we've come full circle from, having Exxon being the biggest stock in the Dow Jones average to now energy is only 3% of the S&P. And if you watch that chart over the years, it's blatantly technology up, energy down, right? And give or take along those lines. There's some nuances within there, certainly, right? Where there's stronger sectors of technology and weaker sectors of energy, but that's what happened. And when you get to the point where I guess there's two things. We had the long consolidation period, and then we tried to have a second breakdown to a new low, and we bounced from there. And to me, that was the best dry heave that I had ever seen in markets, right? Where the whole world is literally looking at how far they might fall from here.
Yeah.
Right. The whole world is like, okay, well, let's see where they land. And what happens? Straight up.
Yep.
Right. So that's when you're like, oh, baby, like this is it. Like that was it. If they didn't get them there, they're never going to get them. And so that's when you have experience with that type of thing, with sentiment so negative, and then all the bears get disappointed, like that's from that time on, that's when you know, okay, now we've got them. Now the market's on the wrong side. Everybody's looking this way. You could physically look over at the solar ETF and see that thing going to the moon, right? Because wind and solar was going to replace fossil fuels as soon as Joe Biden got elected.
Yeah.
Right. So now we're in a position where I think Exxon is probably a better buy at 40 than it was at 15. All right, well, let's just talk about the right numbers, because I'm
No, it's great.
I'm rounding the numbers, but let's just talk exactly. Yeah, I mean, so I
Actually
think
even
Exxon,
have a chart of Exxon up here.
yeah. Now it's going to struggle a little bit because it's at a resistance level, but broadly speaking, I'm more confident buying Exxon at 60 in May of 2021 than I was at 40 in January. Right? Because in that time, they've since pivoted into the carbon capture and storage business. So now, in my opinion, with this view that the green energy revolution is eventually gonna punch itself out, where we're going to get to a certain level of carbon emissions that we're able to put away, we're going to get to a rising amount of solar and wind usage, and then it's just going to level off, right? And we're not going to be able to source, we're not going to be able to source 50% of our country's energy from wind and solar. It's just never going to happen. So once that peters out, we're going to go back to fossil fuels. So Exxon's going to be there. But in the meantime, they said, we've got pumps and pressurizers and all the technology and equipment that we need. We'll store all the CO2 under the Gulf you want.
Yep.
Right. And I think that decision is going to be one that gets studied in Harvard Business School for years to come, about like, how brilliant is this? Like, this company was just dead to rights, politically, socially, culturally, and then all of a sudden opened up another revenue stream to service that movement. And so now I think that they're eventually going to get on their feet. And I could see Exxon literally being $100 stock again. So that's, me maybe pie in the sky-ish view, but I don't see, that's the way things are panning out to me in energy. And you know what I mean? And now we've got an issue with gas storage on top, a gas shortage on top of it.
Yes.
You know what I mean? This kind of this cockamamie cyber attack on the Colonial Pipeline. I mean, I don't know. None of it makes sense or holds a lot of water with me. I don't like to be too conspiratorial, so we won't go there. But these are the types of things that happen when commodities are on the rise that makes them go vertical. Right? Commodities are on the rise. They're bid only. Next thing you know, there's a shortage. What's going to happen? Steeper backwardation and higher prices.
Yes.
So that's what I feel like we're set up for now, Jason.
Nice. Yeah. So, I mean, Exxon, it's all to 100, I think is easy. I don't think that's even pie in the sky. I just think I'm seeing so much sentiment against it, because I know so many energy guys who are energy traders trading the energy market, and they stopped. They completely are against it. If you talk to them now, they might say, hey, I'm long Bitcoin. They're all long Bitcoin. They're all long something. And they go, well, I wouldn't get back into that because, there's better trades right now. It's like, I don't know what's a better trade than something that's been left for dead for years. That's in a trend now, it's starting to move in a nice trend.
Yeah, honestly, the biggest confidence builder for me in being able to go wholeheartedly into this trade was I have clients at pretty big investment banks, at two big investment banks, and I do presentations for them. And I'm showing these commodity slides of the commodity rallies and the tightening curve, and saying that I see massive inflation coming down the pike. And both of these white shoe investment banks came back with a perfectly good explanation why there was no chance at seeing any headline inflation. And I'm like, great, that's what we need. You need the other side of the trade, or else I can't put mine on.
Yes.
And so seeing that, and when you feel like you see the light, and then you've got still a group of naysayers that are kind of what I call intellectually lazy, because they're not considering our 30 trillion debt pile, and they're not considering the floundering dollar, and they're not considering the Fed balance sheet. I feel like saying, okay, I'll put my money up against yours, and if you're right, you can take my money.
Yeah.
Absolutely.
I
So
mean, it's timely bringing you on. The CPI coming in, and all these things that are just it's just raging in our faces now. And for us all, like, have been on that side of the trade this whole time. Like, it's like, man, this has all been happening. Like, you like, even now, like, even I see that kind of says maybe this will pull, but consolidate maybe right now, because finally it's in the, but we've had this amazing move in all of these things. I mean, across the board, lumber, hogs, you name it. I mean, anything is insane right now. So all these things across the board are just looking great. And that leads us to the next one, which is, so many people, I don't agree with this, but so many people think that gold only goes up in inflationary environments, which is not the case in my view at all. And also, I think it's set up very well right now, considering what's been happening and all these things. So I want to ask you, what are your thoughts on gold right now, or have you traded in all your gold, and are you getting laser eyes on your Twitter profile anytime soon?
what would make somebody paint laser eyes on their profile because they're bullish in asset class? Right? I cannot get there. I don't know. Maybe it's me. Maybe I'm an old man and I have, dated thinking, but I can't get there. So what do I think of gold? Yeah, I do honestly, Jason, think that crypto was getting the best of gold for a while. And I had a lot of people that didn't really like that explanation. Right. I was saying, look, man, when I look at gold ETF holdings go from 110 million ounces to, down below 100 million ounces into the mid 90s over the span in the beginning of the year, when gold basically sells directly off from 2000 to where it is now. And during that period of time, Bitcoin just keeps pumping the high with more institutional confirmation and adoption of it. I can look at it and say, look, man, I'm not going to overthink this. People are selling their gold holdings and they're getting some exposure. They're getting off zero Bitcoin exposure, right? So they don't want to have zero Bitcoin exposure. They want to have +1, right? And so now they're selling some of their gold and they're buying Bitcoin. And I think that just took the luster off of gold as an inflation hedge for a little while, right? Everybody's long it because we're expecting inflation. Everybody's long it because it's trending. Everybody's long it because you got to own physical, et cetera. And so gold ran into a period where it was a very long market and Bitcoin was performing and not gold. So people were transferring money into Bitcoin, clear as day to me. Now Bitcoin, there's like 5 sentimental tops in Bitcoin. You've seen the chart that I put out, right? I mean, there's the Elon Musk adding it. There's the Miami Sports Arena. There's the JPEG, right? The $70 million Beeple file, JPEG that traded $70 million at auction. All of these things are so sentimentally toppy, but Bitcoin refuses to go down. And so now you have Elon Musk toying away with it. And now Bitcoin's trading off a little bit, which makes sense to me. But I just think over time, gold is going to have to be in people's portfolio as an inflation hedge. And so I think that it's going to regain its technical trend and retest the highs above 2000 at some point. It may not be the best performing commodity on the board, but it's still close enough to being sound money that we should all probably own some physical in a vault somewhere so that we can sleep a little bit better at night. That's really the essence of my gold trade. I like, if you listen to the Grant Williams podcast with wait, I don't want to get this wrong, not Felix Zuloff, Tony Dayton, right? Grant's last podcast with Tony Dayton. I really like how Tony Dayton uses gold in his portfolio, and he uses gold as the bank. So basically the cash in his portfolio is not in cash, it's in gold bullion. And when he sees something that he wants exposure to, he goes and he sells a few kilos of gold, raises the dollars, and then buys what he wants exposure to. So what he's really doing is he's limiting his dollar exposure to zero, right? To zero, literally, because he sees what's going on with our debt, with our balance sheet, et cetera. And he's very, very bearish the US dollar. So he says, rather than, storing my money, my value in a deteriorating asset, I sleep better at night storing it in physical gold. I can always access gold and sell it for cash when I need to buy something. So that's kind of the way that I look at gold myself. And it's sort of, I like gold to be the sort of core holding at some level and to be the bank. And it still holds a really important role in the portfolio. And I think it will continue to. It just comes in and out of favor with positioning. I really think that's all it was.
Yeah, so I mean, I haven't heard that interview, but that's it's really interesting. That's the way I think of it as well, and what I do, because I really like, everybody hated on Dalio because he came out and said cash is trash, and then basically the COVID crash happened. But now, I mean, he's he wasn't wrong, by any means. I
Yeah,
mean, even if you were in something like gold had a very, people don't remember that, like gold had a really limited sell-off compared to everything else. Like it came down to
yeah,
1500. I mean, it was just, here's your buying opportunity. Some of the miners gave you I mean, it was a
yeah.
phenomenal thing. So that was about it. But I agree, which kind of leads us to the next one, which is, I have my view on this cycle could be a 10-year cycle, could be 20-year cycle, and I think we kind of have to nail this correctly over that long-term time frame. But I know that there's so many money managers, funds, and so on that have this view of the stock and bond portfolio, the 60/40 portfolio. And I think I see kind of this trouble that they're going to have as well, where if you continually to hold those things in this type of environment, and if you go back and really back test it, you'll see that those don't work well over time. They've just worked well lately in the last
Hmm.
20, 30 years. They don't work well over time. So that's one thing that I agree with completely, that you're going to see this shift into things like gold, out of bonds. I mean, bonds are basically a terrible investment right now. Cash is a terrible investment right now.
100%, 100%. And that's why, that'll be eventually what causes, the dislocation in the bond market lower, where the Treasury finally has to come in and say, okay, we're going to do something to support the bond market to keep rates from flying, to God knows what levels. And so that's how, that's how we're playing it. Hopefully, I think that that's the path that I see it transpiring, Jason. You know what I mean? Where, um, well, go ahead. Let's keep going. I don't want to go off on a different tangent. I want to stay on the right pace here.
Okay, I mean, you're nailing great stuff. Nobody'd be upset by it. But
All right, all good, all good.
basically, we're question that, I can understand this, I feel it, but I think it'd be great to hear your opinion on this. Um, Inflation being transitory, what do you think about that? Why do you think they continue to say this? I have my own opinions, obviously, but I want to hear yours completely. Do you think this lasts over time, and why do you think this lasts over time compared to this might be the end right here?
So transitory, I'm not buying into. It sounds like a word that the Fed was used to try to save face, right? And say, look, we're not wrong here, right? We're not seeing spiking inflation. We're seeing transitory, which means we're going to go back to a deflationary environment soon,
Mhm.
right? So that's just their Overton window way of getting you toward, from transitory to, oh yeah, well, we've got it now, right? It's here. It's happening. And over time, they're just going to remove the transitory word,
Mhm.
right? Because they're going to have no choice, because crude oil is not going back to 25 and copper is not going back to 7K. And, the S&P is likely not going back to 2,500 anytime soon. So the inflation thing is going to be, especially now if we keep seeing it come out in headline data, right? That was the
Mhm.
sort of lightning crash that we got this week. All of a sudden, we get this huge core CPI jump of 0.8%, a jump that we hadn't seen since the 80s, freaks everybody out. But to me, that was just a sell the fact event,
Mhm.
right? We've been talking about this inflation. We've been talking about the commodity rally for months. And just because it reaches headline inflation, that doesn't mean that all of a sudden all the corn fills into the silos and the price goes down,
Mhm.
and all of the oil stocks fill up and Cushing fills up and the price of oil goes down, right? Quite the opposite is happening, right? Instead, we're running into supply shortages that are temporarily spiking the price. And so, the cure in commodity price, and the cure in commodities for high prices is high prices, right? Which means that commodity merchants get to pivot and try to produce more of the commodity that's being highly valued. But that takes time, right? It takes time. It takes crop years in the grains. It takes God knows how many years in metals and mining to go and, pull more copper out of the ground than gold this year so that we can service the copper rally and the green revolution. So all that stuff takes time. I don't think that Mother Earth was planning for us to go on this green revolution, which is going to suck up even more base metals out of the mines. And so that's going to leave us with even tighter supplies. So it's the kind of thing where you look at it and you're like, okay, we're going into a new leg of our economy here. We've got the price of copper breaking out to all-time highs. And then, like in the link that I included to my note this morning, we've got metal held outside of LME warehouses down 40%. Right. So we've got a bid fundamentally for the economy and for the green revolution in copper. We've got copper trading at all-time high price, and we've got decreasing inventories. Mm-hmm. There's nowhere for the price to go but up. You know, if people, either that or everybody's going to have to put the buckets down and stop building, which is, not going to happen coming out of the, world's first lockdown of all time. So I just when you look at it from a supply demand side, it doesn't matter what the Fed does. They can't make corn. Mm-hmm. And it doesn't matter what the Fed does. They can't make copper. So that's why I think that the commodity rally is sustainable. And, where it goes within headline inflation is probably going to be the gauge that the Fed reacts to. And so that'll be much more muted than the actual commodity rally and the rally in your grocery bill, right? And the rally in your $25 hot dog and $15 beer at the ball game. And so all of that inflation stuff probably doesn't get measured, but continues to sort of take away our purchasing power. But at the same time, the commodity rally goes on. So it's not one of these things that our purchasing power gets damaged, so it hurts the S&P. It's more like commodities get bid to the moon because you've got people with money have to own hard assets. And people managing money have to own hard assets. And that gets into, then we'll get into that chase at a much higher level. But to me, this is not a trend changing event in the stock market. This is just, okay, stock market's ahead of itself. There's headline inflation, sell the fact, buy it back in moving average support, right? This is just going to be one of those events, if you ask me, because all of the things that are going on, we're still in there is no alternative trade to U.S. equities, right? That's where everybody's still got to be no matter what. So that's how my view kind of stays intact, if that's fair.
Nice. And then that leads us to the next one pretty easily, which is if you're looking at this and you're going, okay, well, oil prices could hit this and this is going to hit this. When exactly do you start looking for, hey, this is starting to put some major pressure, like the consumer staple companies are already seeing a little bit of pressure, but this is going to put some major pressure. Like I like the sectors that you like as well. But when do you think that would start to put major pressure on the S&P when inflation would start to really take, away from that? Because the earnings still look phenomenal right now. Some of these things look great. So at some point I could see that happening, but I'm just not sure when. Once again, it'll be a technical timing thing more than anything for me, at least.
Yeah. And also, technical is for sure will play into it. But I'm trying not to get too caught up in traditional thinking in terms of what the inflation is going to mean, right? Because coming out of lockdown, no matter how you slice it, the consumer still has some kind of forced savings behind him, right? There's no way anybody was able to spend the amount of money, expendable money, unless you invested in something, right? So if you spent money, it was kind of a long-term investment, but you were more than likely forced to save money during the lockdown, right? So I feel like that may offset the inflation a little bit in the beginning, whereas, gas is now $3 a gallon, not $2.25, but that's not a backbreaker to me, right? That's not going to stop me from taking my summer trip, right? 75 cents a gallon, not at all. We get to $5 a gallon, that's a different story. That seems to be the psychological sort of barrier for U.S. gasoline prices, where people are like, over $5 in gas, I'll go sit by the pool in the yard or whatever, Yeah. And that kind of thing, So I think if there's an opportunity that's kind of brewing in my head, it's that would be one of the first sectors affected by the rising commodity prices, mostly gasoline, is the airlines, right? Because they don't really hedge their gas prices, which is, something that I would have been doing aggressively while oil was going to zero if I was an airline, but that's their problem. But what we're seeing now is the airlines have bounced all the way back from their lockdown trough back to the range that they traded in before we went into lockdown. And then I'm sitting saying to myself, well, it's going to be a neat trick for them to replicate all those earnings, because personal travel has got to be down quite a bit. because of the lockdown and coronavirus. Business travel is down massively, likely not to come back, right? A lot of business travel is probably too frivolous to come back in its original form, right? Everything is going to be much tighter managed, much more of a connection with health management of business travel, and it's going to go down that alley. So we're going to lose a lot of business travel, and now the price of jet fuel is exploding. So I'm saying to myself, the airlines have got a couple of things working against them here, where if there's a sector that I'm looking at to start to break down that I want to add to a tech short, against my natural resources longs, it's definitely the airline space. And I'm long transports trying to capitalize on the collateral trade to the commodity rally, right? Because the trucks and rails get juiced when commodities are flying. Airlines have participated, and now they're to a point where I'm a little bit nervous that they might be failing. So now I got to consider that within my transportation risk, and maybe stay long transports and be short airlines or something like that. Because I want to stay long, trucks and rails for the commodity rally and for the 10-year commodity rally, if that's what it turns into.
Very cool. Because for myself, I've been looking at that kind of setup a lot as well, which I kind of moved into the defense sector over everything, just kind of because it's a middle ground to play all that. I think you have a defense stock as well, LMT. Yeah. So I mean, it's kind of a middle ground to play that in a little bit different of a way that might not be under that same pressure. So very cool.
Yeah. It is a good crossroads between, industrials, almost materials, and the political background of clearly the 4 years of no wars is coming to an end. So I would imagine Lockheed and Raytheon find a bid somewhere along the course of that path, but we'll see.
Cool. So the last one, just want to ask so we have a lot of newer traders in the room, a lot of people who are just getting into and finding the groove. So, but let's say, so you have a picture of it about 2 years, 3 years in, being about the minimum. You're about 3 years into trading. What would you tell yourself at that point, about 3 to 5 years into trading? What lessons do you know now that you would tell to somebody at that point, or to yourself at that point?
Dumb it the fuck down. That's what I would start with. I would start with dumb it the fuck down, because you will do better. I used to have all of these worldviews, right? I would read an article about a company and say, this company is not going to last. Tick, 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 short the company. Right. And then I'd read another article and be bullish in this company and be like, oh, I'm bullish this company. Tick, 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 buy that company. Right. And that was some of the dumbest trades that I ever put on in my life. Right. Now, everything that I do is the basis of everything I do is I try to buy things that are going from the bottom left screen to the top right of my screen. Right. Like that's literally what I try to do for a living. Not even kidding. Like I try to find things that go from the bottom left to the top right that I can exploit along the way. And if it's not going from the bottom left to the top right, then why do I want to challenge myself to try to be smarter than the markets and I don't know, pick a top, pick a bottom, decide when something is going to break out of the range? I have no fucking idea. Right. So I stick to my knitting. I stay in my lanes, meaning the transportation, energy, commodity sectors that I'm very familiar with. Mm-hmm. I don't go out of my lanes unless it's to trade a company or a sector that I know about. Mm-hmm. Right. So I'll trade outside of natural resources in a tech company if it's a Peloton company, because I got the bike sitting over there and I can read up on what the product and what the management is about, et cetera, et cetera. So dumb it down, stick to what you know. And I mean, I've been trading my own account for probably 30, 40 years now. And I never do better than when I have like 4 or 5 positions on, all the same direction. Right? Like I never do better when I'm long 5 things and they're all going up. I mean, that may be obvious, but the corollary being 10 long positions, 4 short positions, you know what I mean? Like being all over the map in different sectors, in different countries, right? So I do some consulting for a couple of young traders because I offer a trade apprenticeship program, right? Mm-hmm. And I have taught a couple of young guys by show me the names that are in your portfolio. Mm-hmm. Right. And I don't want to know the positions. I don't want to know the amounts, et cetera, et cetera. And they'll just send me the names and I'll start going over the names and I'll be like, This is a Bulgarian stock market ETF. Are you kidding me? Like literally, like you have money in the Bulgarian stock market. Like I'm just saying, for example,
Yeah.
but I look down these people's, young traders' pads, and like, buy oil is a trade that makes sense to me as a young trader. Buy
Mm,
corn. That's the kind of thing that slaps. Buy Apple.
mm,
Those are the trades that should hit you in the head and that you should be in. You know, short this European center versus long this European center, and long the uranium stocks because your friend sent you this that's not the way to trade.
yeah.
That's not the way to trade, right? Like the way to trade is to figure out your method, to do your homework, to be in the right things, to be long things that are trending higher, to be not catching knives, to be not, things like that. And so it's really just coming down to those really basic principles that have helped me the most. Keep a concentrated pad, one-way trading, trade with the trend. And if you believe it or not, Jason, if you check all those three boxes with every trade, your life gets so much easier,
Oh yeah.
and your blood pressure goes so much lower. You know?
I was laughing at the beginning because like it's so there was a guy when I was on Twitter. I made some posts about something with commodities, and somehow it turned into he retweeted me and like kind of said something pretty nasty, and then it was like, investing isn't for the unsophisticated, because I preach the same thing, which is if you're fighting the trend, if you're like, come, I mean, you have so many people who, like, you'll have a down day and they'll what's, you think this is it, this is the top. I mean, everything takes on so much significance for a lot of the new traders in the room, and I talk about that all the time, which is like, just have your plan. Like, here's your
Yeah.
plan. It's going to break this level, you're out. It's not breaking that level, you're in. Like
Yeah.
very simple. Stay with that, and really, like, know what you're good at. Like, I really focus on the futures markets. I have a little bit more positions on it than you probably do, because I kind of run a very trend system. But once again, it's not anything that I don't understand. I'm not
Yeah, exactly.
you.
It's a system. Exactly. It's not
Yeah,
frivolous. Right.
you have to always be in things you understand. So I mean, all that was just phenomenal. I think the guys in the room will absolutely love that. So really
Good.
appreciate you saying all that.
Yeah, no, not at all. Not at all, man. I've always said that, even when I started this business and went out on my own, I've always said that I'm going to help people, one at a time, if necessary, to
Mhm.
figure out how to not get clocked by markets and how to not get walloped, because I paid for all the lessons. So let me share them,
Yes.
and that's kind of been my mantra. So any way that I could help anybody like you, or like any of the traders in
Mhm.
your group, there's ways that we can do that.
No, I appreciate that. And a few years back when I called you, or you called me, when I asked you about futures knowledge, and you were like, "Oh, just I'll give you a call," and I was like, "Man, that's just super cool," and I really appreciated that. Until this day, that's what I always traded futures, but never like as heavy as I got. So I was really nervous at that time. You kind of took some of the mysticism out for me, because that was the
Yeah.
whole thing, was I was going to move everything basically and start just trading futures heavier. But once again, like, you hear horror stories, so many people trade it, they're like, oh, I have $100,000, therefore I must trade, a million. It's like, whoa,
Yeah.
come
Yeah.
on,
Yeah.
guys. So I
Yep.
appreciate that. I appreciate your time, Tony. That was phenomenal.
Great, man. That's absolutely awesome, Jason. Anytime I can help, I appreciate the way that you're a student of the market. And so anytime I can chime in and, participate with you and kick things around and, just kind of chew the fat and unfold some of the stuff that's going on, that's helpful for me too. So thank you very much for having me.
Hey, thank you, Tony. You take it
All
easy.
right, brother. Peace, bro. I'll talk to you later on.
Later. Thanks so much,
Right on.
Tony.
Yep.